Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cents episode or segment. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here with Chris Bates from the Flint Group. G'day, Chris. How's things?
I'm doing well, Pete. I'm doing well. I just have to say, mate, your hair looks pretty nice today. That's it looks like a fresh wash. Looking very good. If anyone watching on YouTube right now, you'd be able to see his hair is flowing locks. But I've been well, Pete. I was actually up in Avoca. We were going to go to Newcastle, I said on the episode last week, but we ended up going to Avoca and carefully dumped the kids with my mum for a night for only the third time ever. So that was interesting. It's bit of a funny story, to be honest. I quickly booked an Airbnb. This place had a lot of reviews. I was like, this is going to be nice and easy. It's right on the lake in Avoca. Probably too much information to share. But rocked up, and the lady's on the couch. And I'm like, all right, okay. She's obviously a bit social, wants to meet the guests. And we're in the house. She was so lovely. She had like the Beatles rose-coloured glasses on and, a little bit of a hippie, you would call it. And, we're having a bit of a chat, went inside in the house, absolutely stunk of cigarettes. So we were like, so let's go out. Went to some dinner, picked a pretty bad restaurant, and then ended up at the cinema because we couldn't go back to the Airbnb because it stank so much. So, an eventful day in the end. Also did a beautiful hike down Booty National Park, if anyone's been there. Absolutely amazing hike along the coastline there. So, anyway, Pete, that's what's been happening in my world. It was a weekend away at Avoca, which is such a stunning location there on the beach. What about yourself? What have you been up to?
I can remember some brilliant boys' weekends at Copacabana and Avoca. It's a super part of the world. It really is. So, I've actually been away myself this week, also staying in an Airbnb in England. Maybe we should do an episode on Airbnb investing at some point. I think the place we stayed at was all 5-star reviews, and I think when you turn up and everything works and the Wi-Fi works and there's a catalogue of things to do and there's a key box, and I think if you get an Airbnb like that where there's a coffee machine and the TV's all set up, like it's really, really good. It's I guess sometimes the expectations aren't always met, but I was just in Derbyshire in England. Lovely time over there. And what else is I've just booked my return flights to Queensland. So, it's good to see actually the flight costs have come back down to earth a little bit. They went absolutely crazy for a while there for anyone who had to travel internationally or long haul, but maybe just coming back down to normal a little bit and life's getting back towards some kind of normality, which is good to see. So that's my world. Definitely do need a haircut. Thanks for pointing that out. Good fashion radio, as they say. So,
nice little pun there as well, Pete, with the air flights coming back to earth, coming back to the ground in terms of their prices. But absolutely, I'm a massive fan of Airbnb. I mean, we've got well over 50 reviews. I actually don't know how many it is, but this was a similar one where the reviews were actually really good. And because I met her, she was so lovely. I'm like, I'm not going to put a bad review up because she obviously needs the money. It's one of those catch-22s is, you want to warn more guests, but you also don't want to, give them a bad review and affect their income. So, massive fan of Airbnb. I think it's, a lot of people say that's the issues in the property market are caused by that, but maybe that is one factor in, particular markets. But I think it's overblown a little bit. I think people are very hypocritical. They don't want to, they hate Airbnb when it's in their neighborhood and, but when they go on holidays, they love using Airbnb. So you can't have your cake and eat it. It's probably my view on that. When you're coming back to Brisbane, Pete, I mean, it's coming into this spring season, and I don't know. I think we're going to talk about it today. I think everyone's going to be disappointed again. I don't see a big front running of listings. I think we're past the school's holidays now. You should really start to see listings start to jump, and from what I'm seeing in Sydney, that's definitely not the case. What about up there in Brisbane?
Well, yes, PropTrack actually had their listings report out this week for July, and actually there's a number of markets where listings are actually lower than a year ago. Certainly Perth is way down 20%, Adelaide's down 7%, Darwin's down a little bit. the listings are up a little bit year on year. Not so much in Brizzy where they're flat, but Sydney and Melbourne certainly a bit up from a year ago. But they're coming from a pretty low base. That's the thing. So, and I guess with the prospect of interest rates coming down over the next 18 months, I don't think that they're really going to move the needle too much. So I think that's been the sort of the main sort of vibe over the past week or two. I saw the 10-year bond yield in Australia back below 3.9%. So that takes us all the way back to where things were, mid-2023. And I think, look, if you've been following the podcast and listening along at home, that the Westpac cutting their fixed rates this week, it won't be a big surprise, but it sort of captures the zeitgeist, I guess, of lower interest rates ahead. And, I guess you guys, being the brokers, would be right to the front line of that, and interest rates on the fixed rates anyway on the way back down now.
The fixed rate things could have came up over the last couple of weeks, and I wasn't too excited by that, to be honest. It's makes sense that rate expectations and they're going to be a bit more competitive. What I care about is the bank war and variable rates and how much are banks willing to undercut each other and compete for you as a customer. They've all been on the back burner. I don't know, I can't remember exactly when it was, maybe early last year, mid-late last year, where the banks were crying poor. We're not going to make as much profits because mortgage brokers are causing too much competition and making us lower our prices too much. So the Australian consumers winning too much here. We need to, cut back our pricing and protect our profits. Then they release all their profits, higher than expected profits. Our margins are getting better. Yeah. But we've actually seen in the last week or 2 weeks, correlated to those profit announcements and the better news around where interest rates are going, banks are back on the front foot again, and A, matching, but B, undercutting. We're getting variable rates now that are actually better than they were 12, 18 months ago. And so even if you've refinanced, in the last couple of years, now's the time where potentially you can get yourself better deals. And we haven't been able to say that for some time. So, because current pricing's actually been lower, the discounts have been lower than what we were getting, 12, 18 months ago. So I think that's good news. That's good news that the banks war, is going to happen again. And as rates cuts go down, what you're going to see, though, is banks play on apathy. It's just, in the bank playbook, 101, when rate cuts happen, they're not going to pass on what the RBA does. They're going to try to keep some of that in their pocket, and it's going to be up to the consumer to take action with their feet and shop the market and then shop the market again. And so I think to keep the banks honest.
It's been results season, hasn't it, a little bit? So we had a number of the major banks reporting, and strong profits, really, strong performances, pretty much limiting the exposure to the construction downturn and some release of impairment. So pretty good results overall. It was interesting to see interest margins actually ticking up a little bit, even despite pretty intense competition in the home lending space. And I think it seems that, the banks have jumped the gun a little bit because term deposits are on the way down. So even though the Reserve Bank is ruling out near-term interest rate cuts, the banks are sort of getting ahead of that. So, it'd be interesting to see if competition heats up. I noticed CBA are taking a bit more of a sympathetic ear now to property developers. So I guess trying to address that housing shortage, it's been difficult to borrow for developers or people wanting to do major projects. Well, that should ease now. And I think just the other thing that came out of the results or earnings releases in the past week or so is just a massive loss for Dexus. Big write down in the value of their office assets, which is, to be fair, a big chunk of their business. And it wasn't just about the remote work and lower demand. It was also, I guess, a function of higher interest rates, which does tend to depress office valuation. So, I guess we kind of knew that was coming, but some pretty big write-downs there, about 15% in office valuations. So, I guess it's taken a bit of time to flow through to ASX results and so on. But, so the office downturn isn't necessarily just over yet.
Yeah, I mean, we signed a lease, obviously, about 6 months ago. And, I actually, for my personal situation, I wouldn't mind the office market to get a bit tighter and rents to go up just so I feel a bit better for the deal that we've got. But I don't think the deal we've got is any better than what we probably get today, to be honest. And it might be better deals next year. So I can't see much change from what I'm seeing in Sydney. I think if you look at Brisbane, though, Brisbane's got a pretty strong economy, right, from the office valuations compared to what we're seeing in Melbourne and Sydney. And that seems to be a bit more lively up there. Do you think that's the case?
Vacancies have come down? Yeah, I mean, I think, look, the media, there's plenty of puff pieces been put out over the past year about, we're definitely at the bottom. The bottom's just coming, like, sort of vested interest type articles. But vacancy rates in Brisbane do seem to have come down quite a bit. And I think that's, as you said, just a function of big interstate migration. Local economy is doing pretty well. I think as well, if you look at some of the jobs figures recently, well, Victoria's got rising unemployment, and that tends to encourage people to move into stay. So there's a lot of stuff that is sort of flowing in favour of Western Australia, Southeast Queensland, and to some degree South Australia in recent times. So, I mean, the office market, we've been looking ourselves at not too seriously of late, but it doesn't seem that the office market's imploding up there. So anyway, let's crack on with our 3 news stories of the week. So that's what we usually do on our 2 cent segment. We just go through the big 3 news stories of the week. So the first one was Sydney Morning Herald. I think it was Shane Wright at Fairfax. The $20 billion interest bill hammering home buyers and the economy. So a tenth of Australians' take-home pay is now going to mortgages, with about $20 billion paid to cover home loan interest bills in the past 3 months alone. As signs grow that the cost is forcing consumers to cut spending. So that's a quote from Fairfax. So I think it's important to know when you see these numbers, like a tenth of take-home pay, it doesn't factor in that there's a whole swathe of households that have no mortgage debt at all. And then you've got some, particularly sort of people in their middle income earning years, have got potentially quite a lot of mortgage debt. And then you've got the baby boomers with less again. So it might not sound a lot, sort of 10% of take-home pay, but that means that there are some households where it's probably half. So interest costs have really soared over the past year, up about 25%. And I guess that, is working to slow down the economy, lower spending ahead. Potentially there's going to be some easing in the next year. But in the meantime, we've still got some fixed-rate mortgages that are still resetting from low interest rates. So the tightening kind of continues for now.
Yeah, I've still got a one-loan fix, to be honest. Mid-2025, I think it ends, and it's sub 2%. And so we've got still definitely lots of clients that fixed for 4 or 5 years at sub 2% rates. I wish I fixed more, to be honest, but I'd still got a portion fixed up. So absolutely, that's still flowing through. I mean, that whole interest rate cliff, that was a huge conversation, very similar to the conversation of the interest-only cliff back in sort of 2019, 2020. And, these things happen gradually over time, right? People roll off, they get prepared for it. Everyone was like, no one's ever going to get prepared for their mortgage. As soon as their mortgages jump up, they're going to be forced to sell. Like, it's just not the reality. And time and time again, that media story, which makes so much sense when you think on the first level, mortgages go up through the roof, people sell. That's a great article. Well, as soon as you start to really think it through, it's not the reality of what's going to happen in the future. And I do think this article was interesting. I mean, why I think so is because it shows the amount of money that's getting sucked out of the economy and the pressure that households are under just to pay their mortgages. And like you say, the overall number doesn't sound that bad. But when you look at some households, absolutely, they've got very little capacity left over to do everything else they want to do in their life, and they're absolutely having to make cutbacks. So that's interest rates at work. And I do think this also ties into our second story, to be honest, Pete, around job mobility and unemployment. Let's crack on with that one.
Yeah, I think just to wrap up on the first story, I'm duty bound to say whenever you hear a story that says interest-only cliff, fiscal cliff, fixed-rate cliff, there's James Whelan, who's a podcaster and commentator on all things finance and investing. He's got a concept called the theory of thing. And the theory of thing is actually the name of his podcast, which I kindly donated back to him. And the theory goes that basically when everybody's talking about a cliff, then it never turns out to be the major issue that everyone thinks, because it's so well talked about and everybody's aware, and then solutions are found and so on. I mean, there was a recent example in over in Europe with the Brexit debate, and there was all this media scaremongering about, house price crash and unemployment through the roof and goodness knows what else. For every scare story you can imagine, spread of venereal diseases, it was no story too ridiculous. And yet, when the whole process went through, stock market fell to like the lowest in a week or something. And a lot of the stories focus on, in the long term, it's going to cost us 4% of GDP. But the reality is, in an economy with free floating currency, you've got control of your own interest rates. Solutions are found, and we've known about the fixed rate cliff, and for sure the impact has been seen, but it's largely been hitting consumption. It hasn't yet really spiked mortgage arrears. Now, Peter King at Westpac said mortgage arrears are starting to climb. NAB saw 30-day arrears up to about 1.9%, I think I saw this week in their investor pack. So arrears are climbing. They're not critical at the moment, but it hasn't been an absolute disaster, but it is starting. Well, we've seen a whole range of stock exchange releases this week from retail companies, and it's starting to hit consumption as you'd expect. So, the cliff has been more of a sort of a slope so far. So anyway, story 2, Chris, as you mentioned. So this was also Sydney Morning Herald, greater risk for Sydney employees. So insolvencies were 41% higher over the year in New South Wales and up 140% compared with 2021-22, which is, I guess, when we had almost like a moratorium on insolvencies. Construction industry had the most business failures, followed by hospitality. New South Wales made up 42% of all insolvencies in Australia over the past financial year, even though the state's share of the economy is only about 1/3. So, 40% increase in business failures. You'd probably look at that and say that probably points to some higher unemployment ahead. And Victoria, I guess, is facing a lot of similar challenges.
Yeah, I think this plays into a little bit of a trend that we're noticing with our clients. Absolutely. Some clients are doing well depending on their industry and their positions, and are they able to climb that ladder? But there's a lot of clients that are a bit apprehensive on where their job's going to be in a few times. Is the business going to still be in business? If I switch jobs, can I match the salary I'm on? Should I switch jobs right now when I've got a big mortgage and I have to go through probation again, and maybe I don't get that bonus, and I can't get the guaranteed bonus? So I do think there's a little bit of, workers being a little bit more cautious, and that's also flowing into the market. I think that's why markets are a little bit just holding firm at the moment rather than, pushing on, because a lot of people are that demand just isn't as strong as it probably was 6 to 12 months ago. There's a little bit of, I just want to wait and see. But just as that reduces buyer demand, it also decreases listings, right? You end up, when you are cautious, assuming that you're in the market already and you've got an apartment or you've got a house and maybe you're an upgrader and you want a bigger house or you're thinking about buying an investment property, what you end up doing is not selling your place. You end up just going, all right, I'm going to ride it out. Yeah, maybe interest rates are going to go down. Maybe prices are going to go up. But I don't know if I really want to take that risk right now and go into more debt when I'm not 100% confident on my job. And what you're seeing is worker mobility, the ability for you to, job mobility, switching one job to another. I mean, that's way down on it was decades ago. It had a big, that great resignation story back in 2022. It was across every single media outlet. And it was like, everyone who hates their jobs are going to quit at one time. And it's going to be this, huge movement of workers, like a Serengeti migration. But that's generally not what happened, right? We had a bit of a bounce post-COVID, right? But, I think July's some new numbers kind of proved that it was going back down again. And long-term trends are way down. So that's my take on this story, Pete, is that it is one of those things where I do think that gas on the market isn't full pedal to the metal. What about yourself? What's your take on that?
The Great Resignation is a perfect illustration of the theory of thing in the real world, right? Every single media outlet said there was going to be a Great Resignation, and we got a blip, really. So, yeah, look, Well, the credit bureau, Ilian, said small businesses are being much harder hit. So we've had a couple of years of cost of living pressures in New South Wales. Bigger businesses are coping much better than small businesses, said their head of modelling. So, unemployment in New South Wales is actually up about 150,000 over the past year. So no issue there. But the number of people looking for work is up 38,000 from a year earlier. Justin Fabo from Antipodes and Macro said the increase in Sydney's unemployment rate is consistent with the relative weakness in job advertising in the city. So job ads in Sydney are now back to 2019 levels. So there's definitely a bit of potential weakness there. I think as well, actually, to be fair, in Victoria as well, I think Victoria's got the highest unemployment rate at 4.6%. It's got the lowest private sector wages growth. Job ads in Victoria down 32%, according to Jobs and Skills Australia over the past year. So it looks like the economies that are being sort of hit at the moment by interest rates seem to be largely Sydney and Melbourne, whereas Western Australia is still pumping along, South Australia as well. WA's got a massive construction boom ahead of it, I think. And Southeast Queensland just got sort of this ongoing tailwind of people moving to the region. So, yeah, it's a bit of a mixed bag. And, yeah, worker mobility is an interesting one because, in theory, that should sort of take more people to the states with lower unemployment rates like Southeast Queensland or potentially Western Australia, which only has 3.7% unemployment. But, it's not always quite so easy just to up sticks and leave, I suppose.
Yeah, it's an interesting one to really sort of dig deep on. I mean, obviously, there's lots of reasons why people leave one job and go to another job, but often people do it to get more income. And it usually proves right that, when you look at the stats, the people who do move jobs get higher wage increases, right, than the market. And, you kind of go and match the market, what you're actually worth, not what your employer's paying you. And so, but you have to be confident to do that. You have to be confident in your own financial position, whether you've got the cost to take that risk, whether that risk's worth it based on your debt. And I think this is one of the things that higher prices in property really do and it's, they do correlate, right? Where higher prices is leading to bigger mortgages is making you more risk adverse, which is meaning that you might have to have job security is higher, which means that you switch your jobs less, which means that we're probably less productive as a society because we're not moving around to the jobs that best suit our skill set. And so, that's probably me on my high horse there talking about the negatives of higher property prices. But the system we've built is the opposite. Should we go to story number 3, Pete? Obviously, lots to talk about this week.
Well, yes. So on the theme of productivity, so the Sydney Metro is now opened in triumph after 7 years of construction. We got an opening this week. So there's been plenty of doomsaying, as there often is on infrastructure projects, and sometimes with good reason, given the delays and overruns, but successfully delivered by Premier Mins and team. So, look, I'm overseas at the moment, so I haven't been on the Metro. I remember when the airport line opened and there was nobody on it, really, because it was expensive, but it looks like overall a success. I've watched plenty of videos on social media this week, and it looks like something you might see in Singapore, much quicker, more efficient, also quite striking, I suppose, almost beautiful design compared to some of the stuff we've seen over the years. So I think ABC News reported, so riding the new Sydney Metro from Sydenham to Chatswood feels like something from a science fiction movie. Roxy under Sydney Harbour at 100 clicks an hour. That's pretty interesting because a lot of the train speeds in Australia, certainly for somebody coming from Europe, they're just so slow. I did the Sydney to Brisbane train once a few years ago, and I won't be doing it again. 60 k's an hour is a bloody long trip. But the ABC reports shiny new futuristic stations, a far cry from the grimy underground stops that commuters are used to in the bowels of Town Hall or Wynyard. So I guess the general idea is it's driverless, it's turn up and go, trains every 4 minutes through rush hour, and it's a project that's supposed to help with a kind of seamless commute and hopefully get people out from behind the wheels of their cars and onto the public transport. So what do you think, Chris? Any impact for Sydney and the way people live and where they choose to live?
Oh, look, this has been a big story. I mean, I'm probably not a train nerders, some of the ones out there. I mean, there's one guy who came over from Europe to be there for the launch. Then they delayed the launch because they had a bit of an issue, and he had to jump back on the plane back to Europe and didn't get to ride the train. So his YouTube channel wasn't happy. Followers.com or whatever it is. But I do love this, the Metro, and I think it's one of those things where you don't know how good it is until you use it. I was actually, going to put an hour aside in my diary on Monday just to go and use it because I was so excited by it. And I've spoken to a bunch of people who've used it, and they do say it's pretty special. And I think when I've lived in London before and done lots of travel around the world, and just those great subway systems where, we want to go to this part of town. Okay, cool. It means I just got to jump on the line here, change here, and then I can get there. And, the predictability and the reliability, and just like you say, rock up and go rather than trying to plan it. And, well, God, I've missed it. So I have to sit here for half an hour and, maybe I would have been better to drive or get a cab or an Uber, etc. So, I mean, it's still only 2 lines, right? I mean, Metro West is coming, but yeah, you'd be pretty excited if you could start to see some more lines, and they prove the concept here, and Sydney siders take this up, and it's kind of one of those things that compound, right? You have more lines in, more people are going to use it, and I hope that we sort of, the state government's got enough money in its or willing to take on more debt to do more lines. Up the beaches would be nice, please. But yeah, I think it's one of those things where people go, wow, it actually changes your ability to get around the city. And when you follow those lines, Chatswood, St. Leonard's, Crow's Nest, North Sydney, 3 stops, Barangaroo, Pitt Street, Martin Place, Central, Waterloo, if you live in all the way down to Marrickville, etc., and beyond, if you live and up to the northwest, obviously as well, no matter where your, the height, where your job is, you're likely that train's probably going to get you if you're a city type of worker. Whether the office is in Central or it's in North Sydney or it's in Macquarie Park, you can just jump on that train. So I think that's why it's so special. And I do think it will increase property prices around those train stations. Even though a lot of it's been factored into prices, I think some buyers will be like, wow, actually, I really love that. That's actually gives me a lot more options now that it's running.
So true to form, the project cost $21.6 billion. So I guess the original forecast was $12 billion, but almost every infrastructure project has similar overruns, and some of them never get built at all. But as you said, there's new platforms, new concourses, Central Station, Martin Place, where else? New station at Gadigal. So yeah, I guess pretty impressive stuff overall, and funky designs for each station. So Sydenham to Chatswood will take 22 minutes, slashing 13 minutes off the current peak hour commute, which involves switching trains at Town Hall. I think the big thing from my perspective, when I lived in Sydney, I always tried to be close to a train station when I was working in the CBD or within walking distance. And the old stations, to be fair, were pretty old, pretty grimy. And it's good to see something 21st century, I suppose, rather than some of the sort of dated transport options that we've had. So hopefully more of the same to come. I just wonder as well, this is a bit of a microcosm of the juxtaposition between Sydney and Melbourne. Victoria's struggling a bit at the moment with weighed down with government debt at the state level and various other issues about projects or sporting events that didn't go ahead. And it's a big win for Sydney, I guess, to get to deliver a project that had plenty of scepticism, and now it's actually being delivered to a high standard.
Yeah, I mean, I'm excited by it. I think let's just see how the take-up is, though. I think it's already pretty good. I mean, there's already people whinging about the cost of it as well, which is an interesting one. But I think the more you use it, the more benefit you get. I remember the Eastlink in Melbourne, when it first launched, everyone was like, I'm not going to pay that to get across town. And I remember actually using the Eastlink. I think I was living down there. Maybe I was just after it opened. And it was pretty dead. It was like driving on a freeway in China. But go on the Eastlink now, and you're bumper to bumper, and there's that many speed cameras along it as well. So everyone is cruising at the same speed, pretty close to each other. So, yeah, is that your take with this, Pete, as well? I mean, it was just only a few months ago. Everyone was whinging about the Wets Connects, and even that, there's a new element of that opening up around the Sydney airport, which is like the Sydney Gateway. And I think it's one of those things where you make that next trip to the airport, Waze or Google Maps sends you a different way. Oh, actually, it's going down this west coast. Oh, wow, I'm just popping straight out of the airport and haven't got all those traffic jams coming off the other, I think it's the M1. And so do you think, Pete, when people will get these new infrastructure trains, it's not till people really get using it and they go, wow, that actually is way better than, jumping in a car?
Oh, completely. I remember the airport line when it opened and you could, you could choose your seat. There was no, people were saying nobody will pay this. It's the most expensive line per kilometre in the world. And as somebody who's a travel junkie like myself, I often come into international airports at Kingsford Smith, and you can't even get on the like. There's that many people on the line, so it might take some time for things to pick up. But this is the nature of it seems to be the global experience. Once cities go beyond about 5 million, livability becomes a real challenge. Transport projects really need to deliver because it's just harder to get around. So new motorways, new transport links like this, they're all a big part of what can make the big capital cities more livable. And definitely it's difficult because you can't sort of drive across the city as easily when there's 5.5 million people versus when there was 3.5. So yeah, it's good to see though. And I'll be in Sydney in a few weeks. So I'm looking forward to taking a ride. Hopefully no delays like old mate with his YouTube channel. So we'll see how that goes. So just to wrap up this week, interest bill hammering the Aussie economy and home buyers, and that's certainly been reflected in bond yields and money market expectations for interest rates looking pretty disinflationary and on the way down over the next 18 months by the looks of it. Some challenges. I guess this is the balancing act for policymakers. There's definitely a risk of rising unemployment, especially in Sydney and Melbourne. But on the plus side, infrastructure projects opening, including in Sydney. And I think that's been a big part of the dynamic, I guess, Chris, hasn't it, over the past couple of years, is that building units, apartments, townhouses, duplexes just hasn't been a profitable place to be in development and construction. And a lot of the resources been directed towards mining projects and infrastructure. But maybe we'll see a pivot now, I guess, as unit prices go up and interest rates come down. Maybe there'll be a bit of a switch towards housing construction as banks get a bit more sympathetic towards developers.
Yeah, I just think it's one of those interesting times where you go, the land cost is X, my build cost is Y, that's gone up through the roof. My profit margin on top of that means I've got to sell it for this price, and that means that a lot of these projects just don't make sense. And I don't want to do it unless my profit margin's a bit higher than that, because I've burnt so much of my liquidity and my buffer over the last few years. And I've also got a bit more choice. So I'm going to be a bit patient right now and land bank potentially, and just make sure I'm doing real profits that stack up. And so developers are just very picky on where they're working. I do think there's a little bit of an opportunity though for people still right now, because interest rates are sort of still super high, borrowing capacity is still really tight. Worker mobility, which we spoke about, still not 100%. Confidence isn't there. And borrowing capacity goes up once rate cuts happen. So you can't spend your borrowing capacity in advance. You can absolutely, spend it all with confidence, knowing that rates are going down, but you can't spend more money until the rate cuts happen. And so, your price, a lot of the price increases that will happen because the borrowing capacity is increased will be gradual. As rate cuts happen, slowly but surely they get factored into prices. And so you do want to potentially try to get ahead of increases in borrowing capacity that will happen over the next 18 months, 2 years, 3 years. And so if you're in a position where you've got heaps of borrowing capacity, you do want to upgrade, or you do want to buy an investment, you probably, and you've in a really strong position, you might want to take advantage in the market that is a little bit like it is right now, because markets can quickly flip to a point where confidence is back, people are spending more money, listings are really low, you're starting to chase the market, and other buyers like you are getting more confidence. And so I do think, particularly as you move up the price points, that part of the market has been growing at a slower rate versus the bottom end. And that's typically not the case. And it can't happen forever, because people in the bottom end start upgrading to the higher ends because that gap gets smaller, and they want to buy for lifestyle reasons. And so, yeah, potentially playing at that top end is not a bad time. We're finding more and more clients considering that as well. But considering it and doing it are different things. And at the moment, I think a lot of people are in that consideration stage, not so much willing to push the button. And that's even a good news for a reason why you should be considering it right now, because people aren't pushing the button.
Too right. So if you want to have a chat with Chris and the team, Flint, links in the show notes. Likewise, if you want to have a chat with me or any questions, just shoot them through. There's links in the notes. Also, do join us at the Rask Community Forum, community.rask.com.au, chat forum there. Plenty of banter and interaction over there. And of course, if you've got any questions you want us to cover in the show, do let us know. So any plans for the weekend, Chris?
No, I think it's a pretty quiet one, actually. I'm going to support my wife. She's doing the Northern Beaches City to Surf. I'm not exactly sure what it's called. DY to Newport. So, the kids are going to be like, oh, good job, Mummy. You're doing such a good job running. And they're going to be like, Daddy, why aren't you running? I'm like, well, I'm here to take care of you. So I'm taking the lazy option, just taking the kids. What about yourself, Pete?
Wish me luck. I'm camping this weekend. So going to see Snow Patrol and a few other things at a festival down in the Cotswolds. Alex James's Feastival, which is an annual event down next to Jeremy Clarkson's farm, if you're familiar with that part of the world. So I'll be tired next week. No doubt 2 or 3 nights of no sleep ahead for me. So have a great weekend, everyone. And thanks, Chris. Look forward to chatting next time.
Thanks so much, Pete.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.